What's up, everyone? This is Market Pulse USA, and I need you to lock in for the next few minutes because something just went down in the silver market that should make every smart investor pay close attention right now. Over the last several weeks, a massive wave of silver didn't just trade on digital screens as numbers. It got called for delivery, physically demanded, and pulled toward actual possession, like someone with deep pockets and serious intentions was sweeping the entire table clean. Here's the absolutely wild part that should shock you. This wasn't even supposed to be a major delivery season on the calendar, yet the quantities being demanded look exactly like the kind of aggressive move you'd expect from major institutions, sovereign governments, or industrial giants that absolutely cannot afford to be caught short when the music suddenly stops playing. Today, I'm breaking down exactly what happened behind the scenes. Why this matters way more than the daily price action you see on your screen. What the paper futures market is quietly vulnerable to right now, and why the next phase of this move could be faster, messier, and way more explosive than most retail traders are remotely prepared to handle. But before we dive deep into the data, quick support request from the Market Pulse USA team. I'm actively running a campaign to completely eliminate copycat channels that rip original work and re-upload it with zero added value or analysis. If you genuinely value original research and analysis, smash that subscribe button right now. Drop a comment saying Market Pulse USA so I can clearly see who's actually riding with us through this entire journey. Also, if you want daily market updates, quick breaking posts, and my personal analysis that doesn't always make it onto YouTube videos, I created a dedicated WhatsApp channel and community specifically for serious traders. The link is sitting right in the description below. Join it immediately because I drop premium analysis there, including instant voice notes and lightning fast updates the moment markets make significant moves that matter. Now, let's get straight into the actual event itself, because within the first 15 seconds of this video, you should already know the major headline making waves. Absolutely massive amounts of physical silver have been standing for delivery repeatedly. And it's happening again and again, month after month, at a shocking scale that fundamentally changes the entire conversation around this market. Most casual observers think silver is just a price chart and a ticker symbol bouncing around. That right there is the dangerous trap people fall into every single time. The real underlying story is the massive difference between paper promises written on contracts and actual physical metal sitting in vaults. You can clearly see that critical difference when big institutional players stop rolling their contracts forward and start firmly saying one thing. No thanks, we want delivery of the actual metal right now. Think about the mechanics like this for a second to understand what's happening. A futures market can look incredibly deep and liquid on the surface, right up until the exact moment when too many participants simultaneously ask for the actual thing that their contract supposedly represents in the real world. When that tipping point happens, the primary weakness isn't the price level. It's the entire plumbing system holding everything together underneath. Here's exactly what set off the major alarm bells across the industry. In one recent delivery month, close to 70 million ounces were effectively demanded for actual physical delivery instead of cash settlement. Then right after that massive surge, another huge chunk immediately followed in the very next month. Tens of millions more ounces getting pulled out of the system. Add those staggering figures together, and you're looking at a number that pushes dangerously close to 100 million ounces being called for delivery in an incredibly short time window. If you're relatively new to following commodity markets, that volume isn't normal traffic patterns. That's not casual speculation from retail day traders. That's not small investors chasing a momentum move they saw on social media. That's strategic accumulation happening at institutional scale. And it carries one extremely scary implication for the paper market system. Someone with serious financial firepower is deliberately choosing counterparty-free physical metal over convenient paper exposure and contracts. Now ask yourself the question that nobody in the mainstream financial media wants to say out loud on camera. Who executes accumulation at this massive scale with this level of coordination? Is it a federal government entity quietly building strategic reserves behind closed doors? Is it a major industrial buyer that desperately needs guaranteed supply security way more than they care about getting a perfect entry price? Is it a coordinated group of hedge funds that finally realized the extreme tightness in actual physical supply and decided to front-run the uninformed crowd before prices explode? Or is it some calculated combination of all three scenarios working together? Drop your absolute best guess down in the comments section below because I genuinely want to see what you think is really happening behind the curtain while mainstream media stays silent. And while you're thinking hard about that question, remember this. By the time you're watching this uploaded video, a members-only exclusive video should already be published on this channel that bundles all the latest breaking updates in one comprehensive place. If you want the complete timeline plus significantly deeper context and analysis, join the channel membership and watch that premium video immediately. Premium members consistently get the in-depth institutional level analysis we don't always share publicly with everyone. It also clearly shows me who's truly serious about following this work long term. Now let me explain in simple terms why these delivery numbers matter infinitely more than any mainstream headline you'll read. A futures contract market can successfully create the comfortable illusion of endless supply available because individual contracts can be continuously resold, reborrowed, and rehypothecated multiple times over, meaning the exact same underlying claim to metal gets recycled again and again and again. That process creates impressive volume statistics on exchanges. It creates the appearance of deep liquidity for traders. It generates substantial fees for brokers and exchanges, and it creates a comfortable fiction that everything is perfectly fine. Because the vast majority of traders never actually ask for physical delivery of anything real. They simply close their position before expiry. They roll it forward to the next month. They cash, settle the difference. They move on to the next trade without thinking twice. But the exact moment when too many market participants simultaneously decide they want the actual silver metal, the entire comfortable game changes instantly and dramatically. Because paper contracts are incredibly easy to manufacture out of thin air with a few keystrokes. Physical refined metal bars absolutely are not easy to create. This is precisely why delivery behavior sends a louder and clearer signal than any price candle pattern on your chart. Price action can be managed and suppressed for extended periods of time. Market narratives can be carefully engineered by those with agendas. But you absolutely cannot fake the physical act of removing real metal from the available pool without eventually revealing serious stress building somewhere else in the system. That's exactly why this current situation feels fundamentally different than the usual background market noise everyone ignores. Because it's not an isolated one-off event that disappears. It's recurring and persistent behavior. Month after month, absolutely huge amounts are standing for delivery, even in calendar months that are historically not supposed to be heavy delivery months according to normal seasonal patterns. If you're witnessing this kind of aggressive demand happening in a traditionally quiet off month, what do you honestly think happens when a major delivery month actually hits the calendar? That's one major cliffhanger question to keep burning in your mind. Let me slow this entire process down and make the underlying mechanics simple to understand, because once you truly understand how these mechanics work, you'll instantly see why these delivery surges are exactly like smoke coming out from underneath a locked door. On paper in the futures system, a contract is just a standardized legal promise between two parties. A buyer and seller formally agree on a specific price for a future settlement date. Most of the time, in normal market conditions, absolutely nobody involved wants the actual physical metal delivered to their doorstep. They want market exposure to price movements. They want to actively trade and speculate. They want to hedge existing positions. They want to flip a position for profit and move on to the next opportunity. So the entire system architecture is built around the core assumption that the vast majority of participants will never ask for actual physical settlement of anything. That fundamental assumption is what makes the extreme leverage possible in these markets. And that leverage is what makes the trading volume look absolutely gigantic on paper. Now, here's where the situation gets interesting and potentially dangerous. When a futures contract reaches the critical point where delivery can legally be demanded, a buyer can make a choice to stand for delivery instead of simply closing out the trade for cash. Standing for delivery means you're not just betting on silver price direction anymore. You're formally requesting the actual silver metal to be delivered to you. You're basically raising your hand in front of the exchange and saying clearly, I'm not here to play with spreadsheets and paper profits anymore. I'm here to take possession of the physical bars. And when enough sophisticated buyers start doing that simultaneously, the system's built-in flexibility begins to tighten dramatically, because the futures market can create thousands of new contracts almost instantly with a computer. But it absolutely cannot create more refined physical metal quickly at all. This is why physical drain from the system is the real pressure point that matters. Now, you might be wondering a logical question at this point. Why would anyone stand for delivery through a regulated exchange if they can just buy physical metal elsewhere through dealers? That's actually a great question worth exploring. Sometimes it's because the buyer wants complete transparency of the delivery process. Sometimes it's because they want access to a specific pipeline or vault system. Sometimes it's because they deliberately want to force price discovery by stress testing the structure. And sometimes it's because they know the regulated exchange is the exact place where paper contracts and physical metal must meet face to face. And if you want to expose underlying weakness in the system, that's precisely where you apply maximum pressure. Now, there's another critical piece of this puzzle most casual observers completely ignore. Physical inventories are not one simple unified pile of metal sitting somewhere. There are specific categories with legal distinctions that matter enormously. There are bars sitting in exchange vaults that are officially available for delivery, and bars sitting in the same vaults that are stored but not committed to any contract. There are bars classified as eligible for delivery, and bars classified as registered and committed. I'm not going to drown you in complex jargon and technical terms. But the core point is this simple truth. When delivery demand spikes suddenly, the important pool that matters is the one that's actually tied to active delivery commitments and obligations. That specific pool can shrink far faster than the headline inventory numbers suggest to casual observers. And when that critical pool shrinks below certain thresholds, all the incentives change instantly. Premiums change for physical metal. Lease rates change for borrowing. Spreads change between contracts. And eventually, price itself has to respond to the new reality. But here's the dangerous part people miss. Price doesn't always respond first to tightness. Sometimes it responds dead last after everything else breaks. Which is why this is so dangerous for anyone who only watches the price chart. Because the chart is a lagging reflection of the tug of war happening in the physical warehouse that you can't see. Now, let me give you a realistic scenario and tell me if this sounds far-fetched at all. Imagine you're a large industrial manufacturing buyer of silver. You make products that absolutely require silver as a critical input. Your sales team is completely booked with firm orders for months ahead. Your factory production lines are running at full capacity. Your contracts with customers have strict delivery deadlines with penalties. And suddenly, you start hearing concerning whispers that physical supply is tightening significantly, not in the retail coin market that individuals buy from, but in the wholesale industrial pipeline that supplies manufacturers. Your procurement team starts seeing noticeably longer lead times from suppliers. Your regular suppliers start adding unusual conditions to purchase agreements. And you realize, with growing concern, that if you get caught short of supply, you don't just lose a speculative trade. You lose actual production capacity. You lose major customers who won't wait. You lose hard-earned market share to competitors. So what do you do when facing that scenario? You don't buy a little bit and hope everything works out fine. You secure a substantial stockpile immediately. You overorder beyond your immediate needs. You lock in guaranteed feedstock supply. You pay a premium if you absolutely must, because the catastrophic cost of being wrong is infinitely bigger than the cost of paying up now. Now take that exact same urgent mindset and add government entities into the equation. A sovereign government doesn't think remotely like a retail investor watching charts. A government thinks in terms of national vulnerabilities, critical inputs for strategic industries, defense readiness and capabilities. And if silver is increasingly treated like a critical strategic input, then governments will behave exactly like you'd expect them to. They'll try to make absolutely sure they are not dangerously dependent on someone else's exports during a potential crisis. So they stockpile quietly. They prioritize domestic usage over exports. They sign bilateral agreements securing supply. They coordinate with allied nations. And again, they won't announce any of this with fireworks and press conferences. They'll do it quietly through bureaucratic channels. Now, add sophisticated hedge funds to the same room with the same information. Funds see a developing trend forming. They see a technical breakout on charts. They see a compelling macro thesis developing. They see endless currency debasement happening globally. They see exploding deficits everywhere. They see a world that feels increasingly less stable by the day. And they want something real that isn't someone else's liability on a balance sheet. So they buy precious metals aggressively. But here's the critical twist in behavior. Some of these funds don't just want paper exposure to price. They want to dramatically reduce counterparty risk. They want to own the metal in a way that doesn't require trusting a long chain of promises. That's why physical delivery becomes extremely attractive to sophisticated players. And when funds and industry and governments all start pulling on the exact same rope simultaneously, the rope snaps under pressure. Now, this is the exact point where the paper versus physical debate gets brutally real. And it stops being internet drama from conspiracy theorists, because the paper futures market works perfectly fine when physical demand is modest relative to outstanding claims. But if claims multiply exponentially while physical supply is steady or actually shrinking, the ratio becomes a serious mathematical problem. And the way markets resolve ratio problems is never by giving everyone what they want. It's by violently repricing assets, or by rationing available supply, or by suddenly changing the rules of the game. Sometimes all three happen simultaneously. That's why this matters enormously for small retail investors, because small investors are usually told by authorities, don't worry at all, there's plenty of supply available. Until suddenly, one day, there isn't anymore. Now let's bring it back to the actual numbers without copying anyone's specific phrasing. When you see delivery requests measured in tens of millions of ounces, and you see it happening repeatedly over multiple months, you're looking at a fundamental behavior change happening. And behavior change is what precedes structural change in markets. I don't care what the talking heads say on financial television. I don't care how calm the headlines feel. Behavior is truth. Now, one thing that keeps coming up in these insider conversations is the idea that some major buyers are skipping the Western market entirely and going upstream to source material, buying semi-refined material directly, working directly with producing miners, paying substantial premiums to secure guaranteed flow. That should tell you something extremely important. When buyers fear future availability, they stop optimizing for getting the best price and start optimizing for certainty of supply. That's a classic signal of emerging scarcity developing. And you can see the exact same pattern in other commodities historically. When the supply chain becomes a battlefield, money stops acting like money and starts acting like a weapon. Now here's a cliffhanger that you need to remember. If the biggest buyers are accumulating quietly behind the scenes, who is on the other side of that trade? Because every futures contract has a seller, every ounce demanded creates a liability attached somewhere. And if sellers assumed most contracts would be rolled forward, but more contracts are being demanded for delivery, then sellers are forced to source physical metal in a tighter environment. That's where stress concentrates and builds. Now, I want to talk about the banking angle in a careful way. There have been reports and chatter in financial circles that the positioning among major institutions has been shifting. Some appear to be reducing risk exposure. Some may be moving from being aggressively short to being more neutral or even positioned to benefit from rising prices. And if that's true, it means the smart money is doing what it always does. It adjusts before the crowd because the crowd learns through pain. Institutions learn through information. Now, does that guarantee anything? No. Markets can do weird things. But it does reinforce the core point. The real story is not the day-to-day candle. The real story is the flow of physical and the incentives of those who can't afford to be wrong. Now, let's talk about the timeline because people always want a date. I'm not going to give you a magical date like a fortune teller, but I can tell you how these situations typically evolve. First, physical tightness shows up in obscure places. Delivery behavior, premiums, procurement. Second, policy tightness shows up. Export restrictions, strategic lists, domestic prioritization. Third, price tightness shows up. Moves through resistance, jumps, gaps, violent pullbacks. Fourth, narrative tightness shows up. Suddenly the media discovers the story and everyone acts like it's new. We are somewhere between the first and second phase in my view. And that's why watching now matters. Now I also want to address a common trap. Some people see price run and they think it's too late. But in a repricing cycle, late is not about the first move. Late is about the moment the public piles in after the structure has already shifted. If the system is moving from a paper-dominant regime to a physical stress regime, then the new normal price can be far above the old range. In other words, you can feel like you're late while you're actually early for the bigger move. That's why understanding regime matters. Now you might be thinking, okay, but why would this go viral? Why would people care? Because silver is the one metal that sits at the intersection of money and industry. Gold is mostly monetary. Copper is mostly industrial. Silver is both. It's monetary enough to be hoarded. It's industrial enough to be consumed. And that makes it explosive in a world that is electrifying everything. More solar, more electronics, more power infrastructure, more defense tech, more sensors, more automation. All of it leans on silver in some way. So when the pipeline tightens, the pressure spreads. And when pressure spreads, attention follows. Now I want to insert another quick engagement point. If you're still watching up to this point, you're already ahead of most people. So do me a favor. Type "still here" in the comments if you're locked in, because it helps the algorithm understand this isn't a drive-by view. And if you've had a silver win, maybe you bought early, maybe you flipped something, maybe you stacked patiently, share that too. Your story might be the push someone else needs. Now let's deal with the melting ice cube concept without turning it into a lecture, and we're not done. Here's another. When delivery rises while mainstream coverage stays quiet. That silence usually tells you the implications are uncomfortable. Because if regular people understood what standing for delivery really signals, it would change behavior. And behavior is the one thing a paper system cannot control forever. Now, one of the most important background developments is this. Silver has been moving into the category of strategic material in more than one jurisdiction. When a metal is treated like a critical input, it stops being just an investment story. It becomes a supply chain story. It becomes a national security story. And once it becomes that, governments don't behave like traders. They behave like hoarders. They stockpile, they restrict exports, they prioritize domestic needs, and they do it quietly because broadcasting scarcity invites panic. Now, add another factor, refining power. If a country or a bloc controls a large chunk of global refining, it can throttle the flow without touching the mines. It can effectively decide what gets shipped, what gets delayed, and what gets kept. And if export rules tighten at the same time that deliveries surge, you have a squeeze forming from multiple directions. This is the part where I need you to slow down and really picture what's happening. On one side, you have a paper market built on claims. On the other side, You have real-world demand that cannot run on claims. A solar panel factory cannot install paper silver. A defense contractor cannot wire paper silver. An electronics manufacturer cannot solder paper. They need the atoms. And once industrial demand starts acting like a buyer of last resort, price discovery stops being polite. Because they don't get to say, oh, it's expensive, we'll just wait. Their entire production depends on it. Now let's talk about something that should scare every bank and every naked short position in the space. The moment delivery becomes fashionable, the ability to endlessly roll and recycle claims begins to break down. It's the same reason every financial scheme collapses. The moment withdrawals exceed inflows. As long as people accept statements and don't ask for redemption, the system looks stable. But when enough participants say, give me the underlying, the system is forced to prove it has what it sold. That's why delivery is the vulnerability. And that's why a coordinated shift toward delivery is a threat. Now I want to make a clear distinction so nobody misunderstands me. I'm not saying every contract is fraudulent. I'm not saying every exchange is empty. What I'm saying is simpler and more important. A paper system is stable only when redemption demand stays low. And right now, redemption demand is not low. It's rising. It's persistent. And it's coming from entities that are well-funded, well-connected, and likely informed. That's why this matters. Because retail isn't leading this. Retail always arrives late. Retail gets the scraps. Retail gets the headlines after the supply is already spoken for. So if you're waiting for the mainstream to give you a neat little alert that says, hey, physical tightness is here, you're going to get that alert after the easy part is gone. Now let's address the elephant in the room. Who is taking it? When you see tens of millions of ounces being demanded, you have to consider the categories. Industrial giants that need long-term supply, governments that think in decades, not quarters, funds that can move billions without blinking, and yes, sometimes a mix of them using different channels. So it doesn't look like one big buyer. You might see direct deals with miners, you might see purchases of concentrate or door, you might see standing for delivery in exchange warehouses. The common theme is the same: secure supply first, worry about optics later. And if some buyers are willing to pay above what others pay, that isn't irrational. That's a premium for certainty. That's a premium for survival. Now, here's a retention check. If this delivery trend continues, what breaks first? Price or the confidence in paper? That's not a trick question. Price can be managed for a while. Confidence is harder to manufacture once physical gets tight, because every extra ounce pulled out of circulation makes the next ounce more valuable, and every month of heavy delivery tightens the spring. Now, I want to talk about the supply side, because this is where silver becomes uniquely dangerous in a shortage environment. A lot of people assume higher prices automatically bring more supply. That's true in some commodities, but silver is weird. A large portion of global silver production is not from primary silver mines. It's produced as a byproduct of mining other metals like copper, lead, and zinc. That means silver supply does not scale quickly with silver price, because the decision to increase production depends on those other metals, those other economics, those other projects. So even if silver price screams higher supply, it doesn't instantly respond. And in a world where demand is rising from multiple fronts, industry investors, governments, that is a recipe for violent repricing. Now let's add another layer. Silver's usage profile. Gold is hoarded. It sits. It can be recycled easily because it's stored in large bars, coins, and jewelry. Silver gets consumed. Silver gets used in tiny quantities in millions of products. And because it's used in small amounts, it often isn't recycled. It ends up dispersed. It ends up in landfills. It ends up effectively gone. So silver is not just scarce because of mining. It's scarce because of physics and economics. Once it's used, it's hard to recover. And that's why sustained deficits matter. If you have multiple years where demand exceeds supply, you don't reset the system overnight, you drain inventories, you thin buffers, you reduce resilience, and then one day a small shock becomes a huge crisis. Now here's another cliffhanger. If the public is last to the party who gets caught paying the highest prices, it's almost always the late wave. Because early buyers accumulate quietly, then industrial buyers panic, then funds chase performance, then retail arrives because they see the chart. And by the time retail arrives, the market is already in a different regime. That's why you don't want to wait for perfect confirmation. You want to understand the structure while it still looks boring to everyone else. If you got value from this breakdown, do 3 quick things. First, hit subscribe so you don't miss the next update, because this story is moving fast. Second, join the WhatsApp channel through the link in the description, so you get instant voice notes and premium updates. Third, drop a comment, either your theory about who's taking delivery, or simply Market Pulse USA to support the campaign against copycats. And one more thing, if you want me to keep covering silver with this level of detail, deliveries, supply chain policy moves, tell me in the comments so I know what to focus on next. This is Market Pulse USA. Stay sharp stay informed. And I'll see you in the next one.